Silver just delivered one of those market moments that forces you to slow down and reassess everything you think you know about price, risk, and control. In a matter of hours, silver went from looking stable and orderly to completely unhinged, printing a price that most traders have never seen live, then reversing with such speed that it left confusion, regret, and disbelief scattered across the market. This wasn't a clean breakout. It wasn't a simple spike. It was a stress event, and the market left clues everywhere for anyone willing to look past the headline number. What makes this move especially dangerous is how convincing it felt while it was happening. During the quieter session, silver behaved almost politely. Price hovered comfortably above the low 100s, drifting higher without urgency, giving no clear warning that a shock was coming. It touched the low 110s, paused, and held together in a way that suggested balance. Nothing about the overnight action hinted at disorder. That calm is what made the next phase so deceptive. When the main session opened and volume returned, the character of the market changed instantly. Silver didn't climb, it launched. Price moved in a straight line, cutting through levels that normally act as resistance for days, not seconds. Each new high didn't slow the rally, it accelerated it. Buying wasn't cautious or selective, it was urgent. This is the moment when markets stop being technical charts and start becoming psychological pressure tests. Silver ripped higher until it printed an intraday high near 117.84. That number matters not just because it's extreme, but because of how fast it appeared. Moves like that don't come from steady accumulation. They come from forced participation. Short sellers covering at any price. Breakout traders chasing momentum. Options dealers hedging exposure as calls go deep in the money. Algorithms firing because rules were triggered, not because value was found. Then just as suddenly gravity returned. The reversal wasn't slow or thoughtful. It was violent. Selling hit the tape with force, erasing a large portion of the move in a very short window. Even though price remained positive on the day, the speed of the pullback told a far more important story than the closing level ever could. That speed was information. Violent reversals like this don't happen by accident. They reveal where the market was fragile. They show you where leverage was hiding and where liquidity thinned out. When silver surged, buy stops above obvious levels began triggering. Those stops weren't just from shorts protecting risk, they were also from breakout traders entering long positions. Different motivations, same effect. Market buy orders stacked on top of each other in a narrow window. As price accelerated, new stops formed below the market. Long traders protected profits. Shorts re-entered too early and placed stops just above price. The market became layered with conditional orders, fragile and unstable. When silver reached the upper extreme near 117.84, most of the forced buying had already occurred. The fuel was spent. At that point, price had to rely on real demand, and real demand wasn't waiting at that level. Once the forced buying dried up, price didn't gently search for balance. It dropped sharply until it found buyers willing to step in. That long upper wick wasn't noise. It was the footprint of mechanical flow colliding with reality. It was the market telling you exactly how much of that move was urgency rather than conviction. Options activity amplified everything. As silver surged through major strike prices, dealers who had sold calls were forced to hedge by buying futures. That hedging accelerated the upside. But when the rally stalled, that same hedging pressure flipped. What had supported price became supply. This is why parabolic candles so often end with brutal reversals. The structure itself forces it. This is also why asking whether the move was real or fake is the wrong question. The move was real in the sense that it happened. The better question is what kind of participation dominated it. Patient capital behaves very differently from urgent capital. Urgent buying is powerful, but it has no stamina. Silver has a long history of teaching this lesson the hard way. Another layer that matters is how different contracts behaved during the move. In fast markets, the most liquid contracts can exaggerate price action. Liquidity concentrates, rolls happen unevenly, and headline prices can stretch far beyond what the broader curve supports. These distortions are exactly what trigger emotional decision-making, which is why markets like silver thrive on confusion. Looking beyond silver itself adds important context. Gold also pushed to fresh record highs, briefly trading above $5,100 before backing off. That tells you capital is still seeking protection. But platinum and palladium weakened during the same window, and that divergence matters. This wasn't a simple metals up day. Silver was under unique stress. The gold to silver ratio confirms that stress. With the ratio dropping into the high 40s during the spike, silver was aggressively outperforming gold. Those readings are rare. They tend to appear when silver is either entering a new leadership phase or overheating rapidly. Historically, silver leads late in precious metal cycles, but that leadership is never smooth. It comes with extreme volatility. Silver's dual role complicates everything further. It's not just a monetary asset. It's an industrial input. Investment demand can appear and disappear quickly. Industrial demand moves slower, but it's persistent. Electronics, power infrastructure, solar technology, and data systems all rely on silver, and recent production data suggests that demand hasn't softened the way some expected. That underlying pull doesn't vanish just because price corrects. Supply doesn't respond quickly either. Most silver is produced as a byproduct of other metals. Even dramatic price increases don't immediately translate into higher output. New projects take years. Permitting takes time. Capital allocation lags price. This is why silver can gap higher in short windows and why debates about triple-digit prices are really debates about structural tightness, not hype. All of this brings us to the core question: what was today? The answer depends on the time frame you care about. In the short term, today was a stress release. In the longer term, it may have been a boundary test. The market just proved it can trade at levels that previously felt unthinkable. That matters, even if price doesn't stay there immediately. One interpretation is bullish. In this framework, silver tested the ceiling, flushed weak positioning, and may now be searching for a higher base. Holding above psychologically important levels like $100 becomes critical here. That number isn't just technical, it's psychological. It changes who pays attention. It forces industrial buyers to rethink contracts. It pulls in capital that normally ignores commodities. But belief alone doesn't make this framework true. Behavior does. If silver pulls back on declining volume and stabilizes, that suggests consolidation. If selling pressure remains heavy and bounces fail quickly, that suggests distribution. The market will reveal which path it's choosing faster than most expect. The opposing interpretation is more cautious. It views today as a blow-off, a move driven by forced buying, thin liquidity, and leverage, not sustainable demand. In that case, the high print is a warning, not a destination. Silver has a long history of correcting sharply after moves like this, even inside larger bull markets. Both frameworks can be correct in different time horizons. The danger is trading one while thinking you're trading the other. That mismatch is where most losses come from. As the next sessions unfold, the focus shouldn't be on predictions. It should be on observation. How does silver behave when the excitement fades? Does buying appear calmly on dips, or does it vanish until much lower prices? That behavior will tell you far more than any headline ever could. And this is where patience becomes an edge. Days like this expand the range of outcomes. They don't resolve them. Silver just showed you what it's capable of. What happens next will show you what the market actually believes. To really understand what silver just did, you have to step away from the candle itself and look at the conditions that made it possible. Extreme price action doesn't appear out of nowhere. It forms when pressure builds quietly and then releases all at once. Today was that release, and the warning signs were there long before the spike showed up on the chart. One of the biggest forces at work was uncertainty. Not panic, not crisis, but unresolved uncertainty. Monetary policy expectations remain unstable. Growth expectations keep shifting. Political and fiscal narratives change weekly. When markets can't anchor themselves to a clear path, capital behaves defensively. It looks for assets that don't depend on perfect policy execution. That's where precious metals regain relevance. Silver reacts more violently than gold because of its size and structure. It doesn't take much imbalance to push it far. When capital rotates even slightly toward metals, silver often absorbs more of the shock. That doesn't mean silver is always the smart trade. It means silver is the most sensitive one. Positioning added fuel to that sensitivity. Silver had spent a long time being treated cautiously. Exposure was lighter. Confidence was uneven. When price began to accelerate, that underpositioning turned into urgency. Traders who were comfortable watching suddenly felt pressure to act. Short sellers who had leaned on prior resistance levels were forced to reassess. Momentum traders saw signals trigger almost simultaneously. The market went from indifferent to overcrowded in minutes. This is where modern market structure matters. Much of today's buying wasn't discretionary. It was mechanical. Systems don't hesitate. They don't question context. When conditions are met, orders execute. Momentum thresholds, volatility filters, and options hedging rules all activated at once. That created the illusion of unstoppable demand, when in reality, it was a chain reaction of rules being followed. Options exposure played a critical role. As silver surged through major strike prices, dealers who were short calls had to hedge aggressively. That hedging pushed price higher, which forced more hedging, which pulled in more momentum buying. It's a self-reinforcing loop, but it only works while price keeps moving in one direction. The moment price stalls, the loop breaks. When the loop broke near the highs, the market had no cushion. Liquidity thinned out because buyers who wanted exposure already had it. Sellers, on the other hand, suddenly had a reason to act. Profit-taking collided with stop losses and margin pressure. What looked like a collapse was actually the structure resetting itself. This is why silver reversals often feel so brutal. They're not just selling, they're unwinding. Forced buying turns into forced selling, and price has to travel far enough to clear the imbalance. That process doesn't respect comfort levels or popular narratives. Looking at other metals helps confirm this wasn't a simple bullish wave. Gold reaching new records signals ongoing demand for protection, but gold didn't exhibit the same instability. Its move was strong, but controlled. Platinum and palladium, meanwhile, struggled. That divergence is important. It suggests silver wasn't just participating in a metals rally, it was releasing internal pressure. The gold to silver ratio reinforced that message. When the ratio collapses rapidly, it doesn't automatically mean silver is cheap or expensive. It means silver is doing the emotional work of the market. That emotional phase can lead to sustained leadership, but it often includes violent pullbacks along the way. Ignoring that volatility is how traders get blindsided. Another mistake people make is assuming silver's move was purely speculative. Speculation played a role, but it's not the whole story. Silver's industrial demand has been quietly strengthening. Electronics, energy systems, and infrastructure projects continue to absorb supply. That demand doesn't respond to intraday price swings. It responds to long-term planning and physical necessity. This creates a layered market. Investment demand is fast and emotional. Industrial demand is slow and stubborn. When both exist at the same time, price behavior becomes unstable. Spikes overshoot. Pullbacks don't fully retrace. Floors rise over time, even as volatility increases. Supply constraints add another layer. Silver production is not flexible. Because most silver comes as a byproduct of other mining operations, output can't ramp quickly just because price spikes. New supply requires sustained higher prices, stable financing, and years of development. This is why silver markets tend to move in bursts rather than smooth trends. These realities explain why extreme moves don't automatically mean the trend is broken, but they also explain why chasing price at extremes is dangerous. Structural tightness supports higher prices over time, but leverage determines what happens in the short term, and leverage was clearly present today. This brings us to the two competing interpretations that now matter most. The first is the constructive view. In this framework, today's spike was a boundary test. The market probed higher levels, exposed weak hands, and now has the opportunity to build a new base. If silver can remain above key psychological zones, especially near $100, it suggests the market is transitioning rather than topping. Psychological levels matter because they change behavior. Above $100, silver is no longer a niche discussion. It forces attention. It forces recalculation. It forces long-term buyers to think differently about exposure and contracts. Holding that level would represent a shift, not just a rally. But this outcome depends on behavior, not hope. Consolidation requires cooling volatility and controlled pullbacks. If volume fades as price stabilizes, that's constructive. If selling pressure stays heavy and rebounds fail, the story changes. The second interpretation is defensive. It views today as a classic blow-off, a move created by forced flows and thin liquidity, followed by a reversal that exposes fragility. In this case, the market may need a deeper reset before it can sustain higher prices. That reset doesn't invalidate the longer-term story, but it can be painful. Silver's history supports this caution. Past cycles are filled with examples of dramatic rallies followed by sharp retracements that shake confidence and reduce leverage. Those phases feel bearish while they're happening, even if they ultimately strengthen the trend. Which interpretation proves correct will become clearer through observation. Does silver attract calm buyers on weakness, or does demand disappear until prices are much lower? That single behavior answers most of the debate. Macro signals will continue to influence that behavior. The dollar remains a key variable. Sustained dollar strength could pressure metals further. Continued softness would provide room for stabilization. Interest rates matter just as much. Rising real yields challenge silver. Falling real yields support it. Volatility itself is another factor. Elevated volatility changes market rules. Exchanges adjust margins. Funds reduce exposure. Liquidity providers step back. All of that can amplify moves regardless of fundamentals. That's why patience and position sizing matter more than conviction right now. Physical market indicators will offer longer-term clues. Persistent premiums or supply tightness during price swings suggest structural support. Rapid easing would suggest speculation was dominant. Mining equities also deserve attention. If they begin to stabilize and lead during consolidation, it hints at longer-term positioning. If they continue to lag, it suggests skepticism remains. The most important mistake to avoid now is forcing a narrative. Markets don't care about tidy explanations. They respond to pressure. Today released pressure. What comes next will be about how that pressure rebuilds or dissipates. Silver didn't give a clear answer today. It gave a warning and an opportunity at the same time. The difference between those two depends on how the next sessions unfold. And that's where discipline matters. Not because opportunity is gone, but because opportunity paired with impatience becomes risk. Silver has entered a phase where reactions matter more than predictions. By the time a market produces a day like this, the most important mistake to avoid is rushing to conclusions. Extreme moves create urgency, and urgency pushes people to seek certainty. But certainty is exactly what markets with this level of volatility do not offer. What silver delivered was not an answer. It was a signal that the environment has shifted, and that the rules many participants were relying on are no longer stable. One of the clearest messages from today's action is how thin confidence really is. Not fear, not panic, but confidence. Confidence in policy direction, confidence in liquidity, confidence that price will behave normally. When that confidence weakens, markets become reactive. Capital moves faster. Decisions compress. Assets that can absorb uncertainty become magnets, even if only temporarily. Silver fits that role perfectly, but with a dangerous twist. Unlike gold, silver doesn't glide into uncertainty. It lunges. Its smaller market size and hybrid nature mean it reacts more aggressively to shifts in sentiment. That makes it attractive when confidence fades, but unforgiving when positioning becomes crowded. Today showed both sides of that equation. Another key takeaway is how quickly narratives follow price. Before the surge, silver was still treated with caution. After the surge, certainty exploded in both directions. Some saw confirmation of a new era. Others saw proof of instability. Both reactions were driven by emotion, not structure. Markets don't care about narratives. They care about order flow. Order flow today was dominated by forced behavior. Stops triggered, hedges activated, risk limits were hit. When that happens, price no longer reflects consensus value. It reflects urgency. That urgency can carry price much farther than expected, and it can reverse just as fast. Understanding that distinction matters far more than guessing direction. The violent reversal wasn't a failure of silver. It was the market reasserting balance after imbalance. When forced buying exhausts itself, price must find willing participants. If they're not present at elevated levels, the adjustment is swift. That doesn't negate the move, it contextualizes it. This is where time horizon becomes critical. Short-term traders experienced chaos. Long-term participants saw information. Silver proved it can trade at levels that once seemed unrealistic. That expands the range of future outcomes. It doesn't lock them in, but it makes them possible. Macro conditions continue to influence that range. Policy uncertainty isn't resolved. Growth expectations remain uneven. Inflation psychology hasn't disappeared, it's merely dormant. When these forces interact, silver responds faster than most assets. That responsiveness is a feature, not a flaw, but it requires respect. Interest rates remain a key pressure point. Changes in real yields alter silver's opportunity cost dramatically. Even modest shifts can trigger outsized reactions. This sensitivity is why silver often looks calm until it suddenly isn't. The move doesn't start when the rate change happens. It starts when expectations shift. The dollar plays a similar role. It doesn't dictate silver's fate, but it changes the intensity of moves. A stronger dollar can cap rallies and deepen corrections. A weaker dollar can turn caution into momentum. Watching how silver reacts to the dollar, not just the dollar itself, provides better insight. Volatility is now part of the landscape. Elevated volatility changes market behavior at every level. Margin requirements adjust, position sizes shrink, liquidity providers become selective. These changes feed back into price, creating wider swings, even without new information. That's why patience becomes valuable when others feel pressure to act. Physical market signals continue to matter beneath the noise. Industrial demand doesn't trade charts. It follows necessity. As long as that demand remains firm, it creates an underlying pull that paper markets can't ignore forever. But that pull expresses itself over time, not in single candles. Supply constraints reinforce that dynamic. Silver production can't expand quickly. New supply requires sustained incentives, stable financing, and years of development. These realities don't prevent corrections, but they limit how easily prices can collapse without a broader shift in conditions. This is why extreme predictions often miss the mark. Claims that silver must crash ignore structural constraints. Claims that silver must explode ignore leverage cycles and sentiment. The market lives between those extremes, oscillating as pressure builds and releases. After a move like this, the most common outcome isn't immediate continuation or collapse. It's digestion, sideways movement, frustration. That phase resets positioning and drains emotion. It feels boring, but it's where the next trend is shaped. Watching behavior during that phase is more important than watching price. Are pullbacks shallow or deep? Does volume expand on selling or fade? Do rebounds look aggressive or hesitant? These signals reveal intent. Mining equities add another dimension. When they begin to outperform during consolidation, it suggests longer-term confidence. When they lag persistently, it suggests skepticism remains. Neither guarantees outcome, but both inform probability. The biggest risk now is forcing action, feeling like you must do something because something big just happened. Markets exploit that instinct. Discipline means waiting for confirmation, not chasing memory. Silver didn't offer clarity today. It offered transparency. It exposed leverage. It exposed liquidity gaps. It exposed how quickly structure can break under pressure. Those lessons matter more than any single price level. What happens next will not be decided by the spike itself, but by how the market behaves after the excitement fades. Whether silver builds a higher base or requires a deeper reset will be revealed through reaction, not rhetoric. For now, the message is simple. Silver has entered a phase where outcomes widen and mistakes compound. Opportunity still exists, but it demands patience, sizing, and humility. Markets don't repeat perfectly, but they rhyme. Days like this echo through future price action. Studying them carefully is how you avoid being surprised the next time pressure releases. Silver just showed what it can do under stress. The coming sessions will show whether that stress becomes a foundation or a warning. That distinction will define the next chapter.